Momentum appears to be on the side of the housing market, with home prices up 38% since last year. But will it continue into the second half of the year? Jed Kolko, the chief economist at Trulia, Skyping with us this morning. Hello, Jed.
Good morning.
How far into the housing recovery are we?
We're more than halfway back to normal. We look at several measures of the housing recovery to see where we are today compared to the worst point during the recession and the long-term normal level. And right now, we're a little more than halfway back, but there's still a ways to go before the housing market returns to normal.
What trends do you see forming in the second half of the year?
So we've seen very big price increases over the past year. I expect we're going to see those start to slow down a bit. Higher mortgage rates, more inventory coming onto the market, which is good news for buyers, and investors getting a little less eager to buy now that prices are higher should all slow down those price gains a bit. So rising mortgage rates, more inventory, a little bit less investor interest should all bring prices a little more slowly rising than they have been.
What are you seeing among younger buyers? This has been a real problem.
Young people had a really rough recession. Their unemployment rate went way up, higher than it did for adults overall. And even though more of them are starting to get back to work, almost as many are living with their parents as at the worst point of the recession. Young adults haven't started to leave the nest yet. Now, that means that they're not going out and either becoming first-time home buyers or renters. So not only are they not buying, they're not even renting. That means fewer households, and that means less demand for new construction.
Do you think it's going to become easier for people to get loans for a home?
Mortgages are a key question for the rest of this year. Mortgage credit still remains tight, but there are a couple of reasons why we might see more mortgage credit coming on later this year or next year. First of all, because rates are rising, fewer people are refinancing. And that could mean that some banks will focus instead on writing mortgages for home purchases instead of refinances. The second thing is that there are some new mortgage rules that come into effect next year. And those help define what counts as a safer mortgage for banks to lend. With a bit more of that clarity, banks might be more willing to lend the types of mortgages that are deemed safer.
And quickly before you take off, do you see any signs of a serious bubble forming?
I do not see a serious bubble forming. Right now, prices compared to incomes and rents look, if anything, a little bit undervalued, about 7% undervalued nationally.
Thank you for your thoughts. It's Jed Kolko of Trulia. Thanks again.
Thank you.